If you're planning to buy a home in the near future, I need you to lock in and listen carefully today because I have Trey Hooten with First Trust Home Loans here to discuss 3 mortgage blind spots that he's noticed many get tripped up on if they're not prepared for it. Before we get started though, Trey, thank you so much for coming in today. It's a pleasure to have you on the show.
Thank you, Teresa.
Now, I'd love to kind of tell the viewers what your experience has been, and I'm sure in your shoes, you've seen a lot of nightmare stories. I know you're very qualified to have this conversation, but kind of give us a brief history of your work past in mortgages and all of that.
Yeah, so in 2002, I started in the mortgage market under a company called Conseco Finance. And then soon after that, I started with a mortgage broker. And we did that for probably 15 years. And then we moved into a mortgage banking position, and it's been a great fit for us.
And when we were talking before this, you talked about the difference between a mortgage broker and a mortgage banker. Can you just briefly help people understand that?
Yeah, so a mortgage broker is one that has what they call investors, people that fund the loan, and they shop the markets for particular investors. Whereas a mortgage bank, they fund loans themselves, and then they sell directly to an investor. So the advantage of a mortgage bank is you kind of have more control over the transaction, and you have the ability to have decisions made there locally in your office.
Which is fantastic, especially when you can kind of tailor things to you, which we're going to talk a little more about. So as you can tell, Trey's been doing this for a long time in a couple of different settings as well. So you've had the opportunity to see the good and the bad and the ugly of each space to decide where you wanted to fit.
Correct, and we've seen a lot since 2002. So we've seen a couple of falls,
market situations with housing.
Lots of change. Initially when we started, everything was faxed or overnighted, ink, blue ink, and everything now is electronic. It's really streamlined.
Yes, it does make it a little nicer on your wrist when you can just click instead of having to sign 342 times at least. So that's good. I did mine electronic and it was fantastic, although I will say I probably didn't read it nearly as carefully as I would have if it was on paper. So there's the drawback there. But as I mentioned before, we're going to talk about the 3 blind spots that you typically see people fail to notice or they fail to focus on that could prevent them from getting the best deal possible. And the first one we're going to talk about is credit. We all hear people talking about how important your credit score is, but we don't really understand exactly where we need to be. And you said there's a specific number that if you're at that, you're going to probably get better terms.
Correct. So in the mortgage world with most investors that we deal with, to get the best terms available is a 740 credit score. There are 3 bureaus, Equifax, Experian, and TransUnion, and you use the middle of the 3 to qualify.
So like an average?
No, it's not an average. So you have 3 separate scores, and you take the middle of those 3 scores as your qualifying score.
Oh, okay. Got it. And what a lot of people fail to do is treat that credit as a priority.
Yes, a lot of people are not proactive and reactive, unfortunately, and it can cost you dearly, not only in the loan business, but across the board in insurance and everything else. So I try to tell people you need to monitor your credit like it is your checking account.
Okay.
There are several outfits out there that'll do that for you and notify you as soon as your credit changes. So I advise people to look into that and monitor that.
So if you think you're going to be buying a house in the next 2 to 3 years, going ahead and proactively checking it and doing whatever you need to do in advance to get that where it needs to be would be a great first step.
Yes, and people like myself, if you're not at that 740 threshold, we can look at it and tell you some things you can do to improve your score and work towards that.
So giving some coaching.
Correct.
That is fantastic. And we've talked before, we've got an episode called Give Yourself Some Credit where we talk about some good habits for building your credit score. And one of the most important that a lot of people don't realize is just late payments. There are a lot of different utility companies, rental agencies that do report. Credit cards obviously do, but just making your payment on time is so critical in with hospitals, things like that can report, all you got to do is pay something. But ignoring it and not making some sort of payment regularly is really a bad one for that, correct?
And, one exception to that rule, medical collections are not typically frowned upon like other stuff, because unfortunately that happens. So it doesn't impact your score as much. Probably the biggest negative impact on your credit is late payments and any revolving credit card that you would have. Once you exceed about 50% of that threshold, it can start bringing your score down.
Okay, so if someone has, let's say, a $20,000 line on their credit card and they've got more than 10, bad idea, because it's going to affect you.
It can. Once you exceed that threshold, that's when it can affect your score. So if someone has, for instance, a $1,000 credit card and they're at $1,000, typically they can pay that down to $250 or below, and it will drastically improve their score.
That's fantastic. So I think some people will call that the credit utilization score. So just because you have a lot of options, if you're using them, it could negatively affect you. So make sure you're keeping that organized.
And don't ever close any credit lines that you have open. That is a big thing. Well, we're not using that credit anymore, but it looks bad to the bureaus when you start closing those accounts out.
Right. So if you have a big purchase coming, don't use them necessarily, but don't close them either, because it could have an effect on that. And I think it has to do with like the age of your credit, having that long-term record. So managing the credit score, making sure that you're paying attention to what it is, and then possibly getting with someone like Trey who can help you figure out how to get it where it needs to be. Getting that done in advance can really impact your interest rate and, as you mentioned before, the insurance rate on the home that you're buying.
Correct. Your credit score it affects so much of everything you do in life, and can cost you dearly if you don't monitor it.
Yes, and speaking of cost, that goes into the affordability. I think one of the things we talked about a long time ago on an episode was when people are thinking about should I rent or buy, sometimes they'll get stuck on just the payment and not focus on the other expenses that come with home ownership. So that affordability is the next blind spot. Is the home truly affordable, or are you maybe not thinking of everything? And you mentioned things like, maybe HOA dues or insurance costs, utilities, the wiggle room for repairs and maintenance. Those are all things that sometimes can fall off of people's radars.
That's correct, and especially in the insurance market today, we're having huge market shocks, and people aren't prepared for that. Some of the general requirements as far as debt-to-income ratio, meaning your debt that's reporting on a credit report versus what you make, you can go up to 50%. I don't advise people to do that. You're kind of setting yourself up for failure, but self-employed people, that kind of comes into play in that they write off a lot of income, right?
Right.
So if they report more income, they have to pay taxes on it. So they might truthfully can afford more, but they're not showing that income
on paper.
Right.
We had a situation, my first home purchase, my husband had just finished college. He had a contract in hand for a job, but hadn't received 2 paychecks yet. So I was actually quitting my job, but had to delay quitting so that I could secure the financing. The loan was in just my name because I was the one that supposedly had the better income situation, even though he was about to make way more than I did.
Right.
But the same way I would imagine applies for, like you said, self-employed individuals. They tend to want to write off as much as possible. But again, if you're planning for that purchase, it might be better not to do that for a couple of years so you can have that income. Just increase it enough to qualify for the loan you want. Again, that's where coaching comes in handy. And then that way you're not setting yourself up for a difficult mortgage process.
Correct.
And then when you think about mortgage loans, when I was looking at it originally, I remember thinking, okay, if I get on Zillow and I'm at XYZ percentage APR, then I will have this much of a house payment. What I did not understand was taxes and insurance and how much those impact my payment. I was looking at my statement just the other day, and like almost 25% of what I pay monthly goes into my escrow. I think it's actually more than that. And that's not even on a huge house. So I think about the impact for new homeowners, especially when they're trying to calculate all of that. it can make a huge difference in your payment.
Yeah, and things that people don't also consider is, unfortunately, taxes consistently go up, and so does insurance. So today you might feel like you can afford this, but if your property gets reassessed,
which they have recently,
there can be a sticker shock, unfortunately. Things that people typically don't consider are HOA, homeowners association fees. Flood insurance sometimes pops up, unfortunately. But other than that, you need to also look in your local markets, like the utility cost.
Yes.
A prime example of that would be in Conway, Arkansas. They have an entity called Conway Corp. Well, they're a lot cheaper than most utilities.
Oh, yes.
So you might think that you're getting a cheaper price on a home and can afford more, but your utility cost is more. So you really need to look at the big picture of everything associated with that house.
Got it. And I think, too, you talked about 50% being the max. But I agree with you where you said you're not giving yourself a lot of wiggle room if you're at that 50%, because that assumes everything else is in balance. That assumes you don't have high car payments or that you don't have other debt that you're dealing with. So it's important to look at it holistically when it comes to the affordability is really what you were getting at instead of the one little piece.
Right. And, other loans, that's a conventional loan guideline. For instance, USDA, they have 41% as your max. FHA, you can go up to 56%. So
got a little wiggle room there.
Right.
And then our last one, and this is the one we may camp out on just a little bit, is the terms of the transaction. When you originally said this, I was like, I don't know what that means. But what you're getting at is all the little details that go into that contract that also affect the cost. And you talked about how there's certain things you want to pay attention to if it's intended to be a more short-term purchase, and there's others that you really want to focus on if it's going to be a longer-term purchase. Can you kind of break that down a little bit?
Yeah, so in today's market, rates were low for so long, right? In the past few years, they've really gone up. So to sell people and offer lower terms, a lot of lenders out there are charging a lot of discount points, which is a cost to buy your rate down.
Okay.
So it looks good, sounds good when you're visiting with other lenders, but how much did that rate cost you? You need to look at that, right?
So you're paying a premium to get a discount rate.
Right. So then you need to also look at how long do I plan on being at this home, and what does that cost versus the payment? How long will it take me to recoup that cost?
Okay.
For instance, you might pay a 1% fee at 6.5%, okay, versus no discount fee at 6.9%, and it could take you 7 years to recoup that cost.
Okay.
So if you plan on being there 7 years or less, why would you pay more of a premium for that lower rate? Because you're not going to recoup that cost.
Got it. So if it's going to be your forever home, paying that extra cost up front to be able to get a lower rate might be worth it. But if it's not your forever home, pay attention to the total cost is really what you're getting at here.
And especially in today's market, there for a while, it was the norm to not pay discount fees because rates were so low, right?
Right.
So people are the market is tight right now. So people are doing everything they can to market that they have the best terms available. There's some recent litigation going on right now that the government has pursued where a lot of bait and switching is going on. So you have closing cost, you have prepaid items, and you have discount if you pay for it. Well, people are going into closings, and they said, you said the closing costs are X, Y, Z. And they'll say, yeah, well, they didn't disclose that there was a discount fee.
Oh.
And so
they're walking in thinking they needed a check for this amount, and they're having to pay quite a bit more, not knowing they were going to.
Yes, pretty much.
So the fine print is catching people, and now there's litigation because of it, which is understandable to a degree. And and I can imagine the stress of buying the home is enough. With my first home, there was a situation where we thought we had pre-approval, but apparently pre-approval is not the same as like where you have a mortgage. Yes. And so we didn't know the difference, and we almost lost our escrow. We almost lost, or the earnest money, excuse me. Almost lost the house. So this just to me was why I wanted to have you on here, really. And this is going to be my last 2 cents here, is using a mortgage broker, banker like Trey could have saved me so much chaos. And we did, before I knew you, we have used one for the house we have now. They have control over the terms. They can help you consider things to do to make sure that you get the best deal on that home, because this is the largest purchase many of us make. So making sure you're getting that done efficiently and with as little chaos as possible is so important. And Trey, I'd love to hear your kind of final thoughts. If you could say one last thing to our people out there, what would it be?
Yeah, I guess if when shopping mortgage lenders, I highly advise using someone local, hopefully us. But if you don't, use someone that's established, quote a few people, and have someone that can make local decisions for you and that you can actually reach out to in person and talk to. There's so many horror stories out there of online companies and out-of-state companies and promising one thing and doing another. So I highly suggest using a local person within the state of Arkansas.
Perfect. And like we always say, now's the time to start planning. So if you're considering buying a home in the next few years or even in the next few months, now's the time to get those ducks in a row, get everything organized, and connect with your lender to make sure that you get the best terms and there aren't any gotchas later on. Well, thank you guys so much for joining us on Talking Sense today. If you liked what you heard, there's more content on YouTube and on our podcast. Go like, subscribe, and give us a review. Thanks for listening to Talking Sense. And if you like what you hear, make sure and subscribe to the podcast to get all the newest episodes. The Jim Wealth team is available to you 24/7 at info@getreadyforthefuture.com or by calling our offices at 866-653-PLAN. That's 866-653-7526. And while we like to have fun here, we're also financial advisors, and that means disclosures. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and Jim Wealth Financial Advisors are separate entities from LPL Financial.